The world's most successful investor just made a shocking move that has Wall Street buzzing. After selling stocks for 8 straight quarters and building up a massive $325 billion cash pile, Warren Buffett is suddenly buying again, and his latest purchases reveal a strategy that could help protect your wealth in 2025. What made the Oracle of Omaha suddenly change his mind? What opportunities is he seeing that most investors are missing? Today, I will show you exactly what Buffett's buying, why he's buying it, and what it means for your investment strategy in 2025. Let's start with the elephant in the room, Berkshire Hathaway's enormous cash position. For 2 straight years, Buffett has been steadily selling stocks and building what became the largest cash reserve in Berkshire's history, $325 billion. This wasn't just playing it safe, this was Buffett sending a clear message about market valuations. To truly understand the significance of Berkshire's current cash position, we need to look at history. During the 2008 financial crisis, when the entire banking system was on the brink of collapse, Berkshire held around $44 billion in cash. Fast forward to the 2020 pandemic crash, and they had accumulated about $128 billion. But today, they're sitting on more than triple what they had during the pandemic. A staggering sum that speaks volumes about Buffett's market outlook. This unprecedented cash pile tells us something crucial about Buffett's strategy. First, it's a clear signal that he saw most stocks as significantly overvalued and possessed the patience to wait for better opportunities. Second, and perhaps more importantly, it shows that he was methodically positioning Berkshire to strike with massive force when those opportunities finally appeared. It's like watching a master chess player, not just anticipating the next move, but planning several moves ahead. And now suddenly, he's starting to deploy that cash. But here's what makes this story fascinating. He's not buying the stocks everyone else is chasing. Instead, he's focusing on 3 specific companies that most investors have completely overlooked. The first and largest purchase that caught everyone's attention was Occidental Petroleum. In December alone, Buffett poured $405 million into buying more Occidental shares. This wasn't a small addition. We're talking about nearly 9 million shares, bringing Berkshire's total stake to over 28% of the company. What makes this move particularly interesting is the timing. Buffett bought these shares when Occidental stock hit a 3-year low, down almost 25% from its peak. While most investors were running away from energy stocks, Buffett was running toward them. But here's what most people don't understand about this purchase. It's not just a bet on oil prices. Occidental has positioned itself as a leader in carbon capture technology, essentially creating a hedge against the global shift toward clean energy. This is classic Buffett, finding a company that's not only undervalued today, but also positioned for tomorrow's opportunities. But Occidental wasn't Buffett's only move. In a surprising twist, he also poured $113 million into Sirius XM, increasing Berkshire's stake to an impressive 35% of the company. Now, at first glance, this might seem counterintuitive. After all, Sirius XM stock has dropped over 60% in the past year, and many investors see satellite radio as outdated technology in the age of streaming. This is where Buffett's genius starts to shine through. While others see a dying technology, Buffett sees something entirely different, a cash-generating machine with a captive audience. Think about it. Sirius XM generates over $1.3 billion in operating cash flow from its subscription model, and it maintains exclusive contracts with major auto manufacturers. This is about owning a platform that captures valuable drive time attention spans. Buffett bought these shares when they were trading at their lowest point in over a decade. It's a perfect example of his famous quote, "Be fearful when others are greedy, and greedy when others are fearful." Right now, fear around Sirius XM is at its peak, and that's exactly when Buffett strikes. The third piece of Buffett's recent buying spree might be the most telling, VeriSign. Berkshire added another $45 million worth of shares to their already substantial position, bringing their ownership to about 13% of the company. VeriSign isn't a household name, but it's absolutely crucial to how the internet works. They manage the registration of all .com and .net domain names, essentially controlling the backbone of the digital world. This investment reveals something crucial about Buffett's thinking. While everyone else is focused on flashy AI stocks and cryptocurrencies, Buffett is buying the fundamental infrastructure that powers the digital economy. VeriSign's business model is nearly perfect from a value investor's perspective. High margins, recurring revenue, and a virtual monopoly on a critical service. When you step back and look at these three purchases together, a clear pattern emerges. Each company shares three crucial characteristics that reveal Buffett's strategy for 2025. First, they all generate substantial cash flow. In a market where many popular stocks are valued based on future potential, Buffett is focusing on companies that make real money today. Occidental's free cash flow exceeds $4.8 billion annually. Sirius XM consistently generates over $1.3 billion in operating cash flow. And VeriSign boasts an incredible 60% operating margin. Second, they're all market leaders in their respective niches. Occidental is a pioneer in both traditional energy and carbon capture technology. Sirius XM dominates satellite radio and car entertainment. VeriSign literally controls the Internet's address book. This market leadership provides what Buffett calls a moat, a competitive advantage that's hard to duplicate. Third, and perhaps most importantly, they're all currently unloved by the market. While the S&P 500 trades at historically high valuations, these companies trade at significant discounts to their intrinsic value. Occidental trades at just 10 times earnings. Sirius XM's valuation has been crushed despite stable cash flows, and VeriSign's crucial role in Internet infrastructure is largely overlooked by growth-focused investors. However, these purchases tell us something even more important about where Buffett thinks the market is headed. Remember, he's still sitting on over $300 billion in cash even after these purchases. This suggests he sees these investments as special opportunities rather than a broad endorsement of current market valuations. The S&P 500's Shiller PE ratio, one of Buffett's favorite valuation metrics, recently hit its third highest level during a bull market since 1871. Only during the dot-com bubble and the COVID recovery has the market been more expensive. Meanwhile, the famous Buffett indicator, which compares total market capitalization to GDP, recently hit an all-time high. These extreme valuations explain why Buffett isn't rushing to deploy all his cash. Instead, he's selectively picking companies that combine strong current cash flows with depressed valuations, essentially finding islands of value in an ocean of overpriced assets. So what can we learn from Buffett's recent moves? The first and most important lesson is about patience. Consider this. Buffett spent 8 consecutive quarters primarily selling stocks and building cash. That's 2 full years of watching others make money in the market while he waited for better opportunities. Most investors can't maintain that level of discipline, but that's exactly what sets Buffett apart. Think about Occidental Petroleum. Buffett didn't just buy it once. He's been steadily accumulating shares whenever the price drops significantly. His first major purchase was when shares were trading around $60. He bought more when they fell to $50. And now with shares hitting the mid-40s, he's buying again. This averaging down strategy only works if you have both the conviction in your analysis and the patience to wait for the market to recognize the value you see. But there's an even deeper lesson here about market psychology. When Buffett started buying Occidental, many analysts questioned his judgment. Oil is dead, they said. Everyone's moving to renewable energy. Yet Buffett saw what others missed, that the transition to clean energy would take decades, not years, and companies like Occidental that are positioning themselves for both the present and future would thrive. One of the most powerful lessons from Buffett's recent moves is about the strategic value of cash. In today's market, many investors view cash as a wasted asset, pointing to inflation as a reason to stay fully invested. But Buffett's approach shows us that cash isn't just about preserving wealth. It's about maintaining the ability to act decisively when opportunities arise. Think about it this way. While Berkshire holds $325 billion in cash, they're not actually losing money to inflation. A significant portion of this cash is invested in short-term treasury bills, currently yielding around 5%. This means Berkshire is earning roughly $16 billion annually just on their cash position, while maintaining the flexibility to make strategic purchases when prices become attractive. This strategy becomes even more powerful when you consider Buffett's approach to valuation. He's not trying to time the market or predict where prices will go next week or next month. Instead, he's waiting for specific companies to hit his predetermined buy prices, prices that represent a significant discount to his estimate of their intrinsic value. Looking ahead, Buffett's recent purchases give us important clues about his vision for 2025 and beyond. First, buying Occidental, he's signaling that traditional energy companies still have a vital role to play, especially those investing in carbon capture and other future-focused technologies. This isn't just about oil prices, it's about the fundamental transformation of the energy sector. His investment in Sirius XM suggests he's seeing enduring value in subscription-based business models, even in industries facing technological disruption. While streaming services proliferate, Buffett recognizes that Sirius XM's car-based ecosystem and exclusive content create a moat that's harder to breach than many realize. And with VeriSign, Buffett is betting on the continued growth of digital infrastructure. As artificial intelligence, cloud computing, and the Internet of Things expand, the need for reliable domain registry services only grows stronger. It's a perfect example of finding unsexy but profitable businesses in exciting sectors. So how should individual investors apply these insights to their own portfolios? When it comes to applying Buffett's recent moves to your own investment strategy, it's crucial to understand that blindly copying his purchases isn't the answer. Instead, focus on the timeless principles these moves reveal about successful investing. The most striking lesson from Buffett's current strategy is his approach to cash reserves. While you don't need to match Berkshire's massive 30% cash position, maintaining meaningful reserves isn't just about playing it safe. It's about having the firepower to act decisively when exceptional opportunities arise. This ties directly into another key principle: the willingness to look where others aren't. In today's market, while most investors chase the latest artificial intelligence and technology stocks, Buffett is finding value in overlooked sectors. His recent purchases all share a common thread. They generate substantial cash flow today rather than just promising profits tomorrow. This focus on current value over future potential has been a cornerstone of his success. Perhaps most importantly, each of his recent investments demonstrates the critical importance of competitive advantages. Whether you're looking at Occidental's energy assets, Sirius XM's automotive relationships, or VeriSign's internet infrastructure, these companies all have strong, defensible market positions that protect their profitability. These moats, as Buffett calls them, are what transform good companies into great long-term investments. As we move through 2025, keep watching Buffett's moves, but more importantly, watch his principles in action. The market will always go through cycles of fear and greed, but the disciplined approach of waiting for quality companies to trade at attractive prices never goes out of style. What do you think about Buffett's recent purchases? Are you seeing similar opportunities in today's market? Share your thoughts in the comments below, and don't forget to like and subscribe for more market insights and analysis.